So the ratio that's most important to me as an owner is what's called the prime cost, right? And it's the cost of goods plus your cost of labor. When it comes down to it, it costs X to keep the lights on. It costs Y to run your coolers. Rent is Z. It is what it is. Those things are typically fixed cost or fixed cost with some adding over the years. But you know where you're gonna sit with those, right? What you don't know is, what are my cost of goods? Am I gonna have a lot of waste this day, this week, this month? Is my labor gonna be poorly managed and I have too many staff members on? Is it gonna be poorly managed and I have too little staff members on? Both bad things. That number, that prime cost of goods plus cost of labor, is the one thing you can truly manipulate. I mean, yeah, you can negotiate with your landlord at some point about certain things, and you can do these other things, but on a day-to-day basis, the two numbers, cost of goods plus cost of labor, which come to that prime cost, that single cost, is the most important thing. It's how you breathe. It's whether you live or die. It's whether your restaurant's around in 2 years or not.
This video offers insights and inspiration on why you would want to calculate and understand your financial ratios, what you need to get started, what are the key financial ratios to monitor over time and against other businesses in your industry, and practice how to read a business ratio scorecard.
The number one metric that I think is important is foot traffic, the number of customers that walk in the door, because that will really determine over time how much you're going to sell. The next thing that I always like to look at is expenses. We want to try to keep expenses as low as possible so that the operation runs as smooth as possible. But besides those two metrics, we always are looking at sales, and we're always looking at sales per customer. And I think it's those four items right there that are probably the most important to us.
Why calculate financial ratios? Why should I care about financial ratios? Well, financial ratios will help you compare your current financial position to its past history and to other businesses in your industry. The information helps you focus your attention on the areas of financial strength and weakness, what's working and what needs to be improved. Based on this information, goals and an action plan can be developed to proactively manage the financial performance of the business. For example, if your debt-to-worth ratio is increasing over time, it could mean more debt is taken on. It could also mean net worth is decreasing due to net losses, owner distributions, or both. The higher the debt-to-worth ratio, the more the business has borrowed to purchase the assets used to generate sales. Sometimes this is necessary to get a business started, for acquisition of another business, or for expansion. Reviewing ratio trends and understanding the story behind the numbers is essential for making future plans. How do I get started? To calculate financial ratios, you need a set of accurate financial statements, including an income statement and a balance sheet. Fiscal year-end financial statements capture the best data to compare over time. However, calculating ratios on a monthly or quarterly basis allows you to be timelier in managing financial performance. Key financial ratios. Ratios measure one number against another. For example, financial ratios are used to determine how effectively and efficiently a business is using assets to generate sales, how well it manages costs to generate a profit, how quickly it can turn inventory into sales and cash, and how it uses borrowed money versus equity to finance assets. There are many ratios used to measure business financial performance. Some ratios are industry-specific. For example, the hospitality industry uses average daily rate and revenue per available room. Restaurants use annual sales per square foot. If your business has industry-specific ratios and measures, be sure to implement those in your analysis. Okay, so let's review how to convert a ratio into plain English. For every $1 of denominator, there is X dollars of numerator. You'll see this demonstrated in the 14 ratios covered on the scorecard. We will review 14 common ratios used on a sample business scorecard, which reports the key financial ratios for the past 2 years, along with the industry benchmark and company's trend. Balance sheet ratios are computed from numbers taken from the balance sheet and measure the stability of the business. The balance sheet is very important. The current ratio measures the ability of the business to generate cash and pay bills due in the next 12 months. It's calculated by taking current assets divided by current liabilities. In the prior year, this business had a current ratio of 1.88 to 1. So for every $1 of current liabilities, it had $1.88 in current assets, which may include cash, accounts receivable, and inventory. It had more current assets than current liabilities, which is the goal. If there is more current liabilities than current assets, the business will experience cash shortages and it may take longer to pay bills. In the current year, the ratio was 1.91 to 1. So for every $1 of current liabilities, there is $1.91 in current assets. The ratio increased from the prior year, meaning the amount of current assets relative to current liabilities increased. Trend is up. Next, the industry ratio is 1.20 to 1. So for every $1 of current liabilities, peers in the industry had $1.20 in current assets. So this business is outperforming the industry's current ratio. The quick ratio takes the current ratio one step further and eliminates inventory from the equation. Inventory may take longer to sell and generate cash to pay bills. To calculate the quick ratio, add together cash and accounts receivable and divide by current liabilities. A 1-to-1 quick ratio is desired, but not always easy to achieve and depends on the industry. In this business, for every $1 of current liabilities, there was 83 cents in cash plus accounts receivable in the prior year. In the current year, there is 76 cents in cash plus accounts receivable. Trend is down. This amount is less than the prior year, but better than the industry, which has 40 cents in cash plus accounts receivable for every $1 of current liabilities. Okay, now, the debt-to-worth ratio tells us how much of the business assets have been purchased with borrowed money versus owner equity. The more borrowed money, the higher the interest expense, which reduces profits on the income statement. It's calculated by taking total liabilities divided by net worth, also called owner equity. In the prior year, for every $1 of net worth, this business had $1.16 in total liabilities. That ratio went down in the current year to $1.09 in total liabilities for every $1 of net worth. A declining debt-to-worth ratio is positive, so the trend is up. The industry reports for every $1 of net worth, there is $4.80 in total liabilities. So why is this business doing better than the industry? Well, possible answers include: the business is repaying existing debt on schedule and not incurring new debt, or profits are reinvested in the business to increase net worth. Income statement ratios. Income statement ratios are computed from numbers taken from the income statement and measure the profitability of the business. Gross profit is the amount of money left over from a sale after paying for the direct cost of the sale. Gross profit margin is expressed as a percentage of sales computed by dividing gross profit by sales. In the prior year, for every $1 of sales, there is 29 cents of gross profit. In the current year, that same dollar of sales generates 27 cents in gross profit, a decline from the prior year and slightly less than peers in the industry who generate 27.9 cents for every dollar of sales. Trend is down. Optimizing gross profit margin is essential, as gross profit is needed to cover all the operating expenses of the business as well as leave a profit. Net profit is the amount of money left over from a sale after paying for the direct cost and all operating expenses of the business. Net profit margin is expressed as a percentage of sales computed by dividing net profit before tax by sales. In the prior year, for every $1 of sales, there was 4 cents in net profit. That dropped to 2 cents in the current year. Trend is down. However, the peers in the industry generated a penny in net profit for every $1 in sales. Remember, net profit is what is used to repay debt, to reinvest in the business, and for owner distributions. Asset management ratios. The next set of ratios measures how efficiently the business is using its investment in assets to generate a return. Numbers used in the formulas are taken from both the balance sheet and the income statement. A business buys assets to generate sales. Sales to assets measures how effectively the assets are used to create sales. To calculate this ratio, divide sales by total assets. So, in the prior year, for every $1 of assets owned, $2.29 in sales was generated. In the current year, $2.36 in sales was generated. So, trend is up. The industry peers generated $2.70 in sales for every $1 in assets. This business may be able to increase sales by using the assets more effectively. Or perhaps there are assets that are not being used and should be sold. Return on assets is commonly known as ROA. Return on assets measures how effectively assets are used to generate a profit. Take profit before tax and divide by total assets. In the prior year, for every $1 of assets, 8 cents was generated in net profit. That dropped to 5 cents in the current year, but is higher than the 2 cents the industry produced. Company trend is down. Return on equity is commonly known as ROE. A business owner or investor puts money into a business with the goal of making more money. The ROE is calculated by dividing profit before tax by net worth. In the prior year, for every $1 of net worth, the business produced 17 cents in net profit. In the current year, it was 11 cents. Trend is down. The industry reports a higher return of almost 22 cents in net profit for every $1 in net worth. Asset management ratios, working capital. The final sets of ratios are used with businesses that carry accounts receivable and inventory. Monitoring the cycle of turning accounts receivable and inventory into cash is essential to maintaining good cash flow. Establishing good accounts receivable collection processes and employing efficient inventory control systems ensure that cash needed to pay bills is not tied up longer than it should be in either area. Inventory turnover is the first step in calculating how long, on average, inventory sits on the shelf before it is sold. Take cost of goods sold and divide by inventory. In the prior year, inventory turned over 5.8 times. It turned over less in the current year, only 4.7 times. Trend is down. The industry turns inventory an average of 9.1 times in a year. Inventory days is a better way to understand inventory turns because it converts the turns into the number of days it takes to sell the inventory. To do this, divide 360 or 365 days by inventory turnover. For this case study, we use 360 days. In the prior year, it took 62 days on average for inventory to sell. In the current year, it took 77 days, which is much longer than the industry average of 40 days. Company trend is down. This business may want to explore options to eliminate any obsolete inventory and consider a just-in-time inventory system or better inventory control systems to reduce the time inventory is sitting on the shelf before it's sold. Accounts receivable turnover and turn days measure how long, on average, it takes to collect money owed from a sale made using an invoice or promise by the customer to pay in the near future. If some sales are cash sales, determine the amount of sales made on credit and use that figure for these calculations. Start by calculating accounts receivable turnover. In the prior year, sales divided by account receivable equals 11.5. This means accounts receivable turned over 11.5 times in the prior year. An easier way to understand turnover is to convert it to number of days. Divide 360 by 11.5, the number of times accounts receivable turned over, to arrive at 31 days. The business collected accounts receivable in 31 days on average in the prior year. In the current year, it took 35 days to collect. Trend is down. The industry collects accounts receivable in 33 days. The goal should be to collect at least as fast as the industry. The faster you collect, the faster you have cash that can be used to pay bills and buy more inventory. Accounts payable turnover and turn days measure how long on average it takes the business to pay vendors. You want to pay your vendors within terms to avoid costly late fees and interest. Vendors may offer discounts on your bill if you pay early, which lowers your cost of goods sold. Again, start by computing accounts payable turnover and then convert to days. Divide cost of goods sold by accounts payable to arrive at turnover of 10.1 times. Then divide 360 by 10.1, which equals 35. Now, in the prior year, this business paid its account payable in 35 days on average. In the current year, it took longer, 39 days. Trend is down. The industry pays accounts payable in 30 days. So this business may be paying late fees or interest and missing out on discounts by taking longer to pay than peers in the industry. And of course, additional fees and missed discounts reduce profitability on the income statement. Create your own scorecard and practice reading the ratios. Think about what the trends are in your business. Why are your ratios improving or declining? What actions can you take for the future? Ask your banker, industry association, or financial advisor for industry ratios and compare your performance against your peers. Establish a habit of monitoring and managing the financial performance of your business. This puts more control in your hands, helps to avoid surprises, and allows you to work on maximizing the return on your investment.
One of the things we track, I'm sure every business should track, is the salary load on gross income. And there are metrics in the marketing agency business. There are benchmarks, and we track salary load to those benchmarks. We track AGI as a percent of total revenue to those benchmarks. You learn all those benchmarks, you track them, and then you pay attention to them, because if they start to get out of whack, you're headed for trouble. And then what you have to do is you have to have the courage to take the action that's required.
We realize the success of your business directly impacts the success of your community and its people. So we push a little harder and we care a bit more, because it's not profit for us, it's prosperity for all.